Hey, so I'm Freund, and we're in Freund's Farm Market in East Canaan, Connecticut. That sits right next to Freund's Farm Inc., where we milk about 270 cows twice a day. We milk the cows every day of the year, and we merchandise their milk, obviously, and then we also sell their manure in the form of CowPots. My sister-in-law has this market where she's obviously in the middle of the gardening season. My dad started the farm in 1949, actually at a different location, and he moved here in 1951. And then he and my mom incorporated the farm in 1978 to facilitate the transition to this generation. Well, we participate in at the catastrophic level for the field crops. In this area, we bought up a few times, but that's not as much of our strategy as on the livestock gross margin, which is a program that we've taken advantage of over the last several years. And that has been very important. And that's kind of an all-in-one product that you can tailor to your farm. And we can work with the risk of what it costs to make the product. So one side of the scale measures what it costs you for inputs and for feed specifically. And the other side of the scale deals with the milk, price that you're being paid, and what you guarantee is the margin between those two. We use it kind of on a rolling basis. Our particular farm, we like to roll 3 months at a time, and we go out a certain period, so we're constantly, in any given month, we have 3 months worth of margins that we get guaranteed based on what the markets are for the time period in which we choose those. So it's a little bit complicated, but it is there, and it does give us that guaranteed margin, which does secure kind of our farm in a way for those periods where we're able to get a margin that's acceptable. Well, probably our biggest risk is weather. We also have a lot of market risk. We have market risk on both sides, both from selling our milk. We go have frequent roller coasters that we ride up and down the price-pay scale there. And on the other end, we buy a lot of inputs. So there's a lot of inputs that we have no control over, and we have no control over our pay price. So market on both sides is a very, very big deal. So in our particular farm, we work closely with an insurance agent. We get usually a notice what the projected margins are going to be a couple weeks out before I believe it's the last Friday of the month when they do the calculations, or they actually accept it and peg what the actual margins are going to be. But a couple weeks before that, you have an idea of what the markets are saying in terms of what the price of milk, pay price for milk will be, and also what the cost of your feed inputs is going to be. So based on that, we get together with the agent and we talk about different strategies. Do we want to go out 10 months? Do we want to go out and do 3-month intervals, 5-month intervals, whatever the different options are. And then we pick a deductible based on what we want to take in risk, the deductible being risk on our part. And that determines it, but the higher the deductible, the lower the premium, so you weigh one against the other. And so we choose a program that we want to go in with. We fax the sheet with the information on it, and then we find out the following week, usually the beginning of the next week, whether the application made it through the whole process or not, and if we have that guarantee going out. Then several months later, you find out whether you actually always hope that you don't get anything back, because you hope that the market beats the expectations. When that's not the case and you have the guarantee there, then you will be paid the difference between what the market is and what the guarantee said. And if it's negative, you just owe the premium, and if it's positive, you get those dollars back in your pocket. And then you have to judge for your farm. What can you afford for premiums? How do you value that versus the protection going out into the next year? It's important. We try to protect about half of the milk that we produce, and so it's going to help us level out either through paying premiums or receiving proceeds from the insurance. So one way or another, you're kind of smoothing your earnings going out into the future. And that's important in a business that's volatile. At least you can take and adjust one of those streams. You can't control the weather, and you can't control huge fluctuations in the market, but you can kind of modify them or mollify them a little bit, if you will, with the insurance program. So it's an important tool. It's an ever-changing tool because it's government-based. Things change, rules change, and other programs come into being to consider. But having some kind of risk mitigation on the farm, because it's available, it's something that's worthwhile getting to understand and to use.